and it said that approximately 40 to 60% of the portfolio should go into guaranteed lifetime income annuities, covering those essential living expenses. Again, we have a saying, it's as little as possible, but as much as necessary when it comes to funding the annuity and answering the question, how much should you put in? We reverse engineer that equation. It's how much income do you need? Well, you start with a budget. You start with your living expenses, and whatever that is month to month, we then create a plan for it. We take in your social security and a pension if you already have one, or don't. If you don't, we don't include that, obviously. And then we do the back of the napkin math, and whatever's left, or the difference or the gap of income to expenses or expenses to income, we then fill that with the annuity. And whatever that ends up being, then we take those remaining assets, in this case 40 to 60%, and we invest in an equity portfolio or growth oriented portfolios to provide inflation protection, discretionary spending capacity, and legacy building. One of the biggest things I get, objections, if you will, when it comes to annuities is, well, that's a fixed income. What about inflation? Or annuities are a bad deal because they don't address inflation. Those are people that are thinking, one-minded. They're not really thinking about how the annuity serves them in the capacity that it's built to serve them for that one purpose of providing a floor of guaranteed income. Your other tools, in this case, the portfolio invested in equities, is your inflation buffer. If you're just putting a small demand to address inflation for your future income, you're not putting a lot of pressure on that growth portfolio. You're not asking it to do much. You're asking it to provide maybe 2 to 3% return annually. And any solid portfolio should be able to do that. I mean, the S&P 500 has averaged over a 7% return since its inception in 1957. So ultimately, this strategy is superior. Why don't you cover those points, Zach? Can you see it?
Yeah. So why is this strategy superior? Stability and confidence, right? So retirees with pension-like guaranteed income, such as annuities, do demonstrate consistently higher satisfaction, psychological comfort, and spending confidence. Um, I really, again, that brings back the point of the annuity and its value, and bringing up the next point, risk management. This structure robustly addresses longevity, inflation, and sequence of return risk. Then there's also the growth potential that comes with this planning as well. So we had talked about that other roughly 50%. The equity allocation allows meaningful portfolio growth without jeopardizing retirement security, enabling optimal wealth accumulation. So if you want to, I say we break this down a little bit more. And I do want to add just a quick point. We realize AI technology is not perfect. But ChatGPT's accuracy and it's also nuanced, context dependent. It does with studies suggesting an accuracy rate of right at about 88%, actually a little bit over that 88% mark, and that's based on general knowledge questions. So, considering the consistency of that question, the results that it's producing are pretty darn good with an AI component. Um,
Yeah.
with that being said, I just wanted to break down this a little bit more and cover some more details that we saw here.
What details?
Yeah, jumping back up to keep going. The guaranteed lifetime income and the psychological benefit.